Hey everybody, this is Jose Blasco sound check. We are about to start in 20 something seconds. Can you have a quick hello in the chat box? That would confirm that you hear me well. Thank you so much, guys. Just a quick confirmation we do so I know when we start the session, it's all good. We should be, but always useful to have a simple confirmation like that. Very nice. Perfect. Well, thank you very much. How are you, Fermon? Very nice. Good to see you all, guys. Welcome to the session, everybody. Today is August 13, 2020. By the way, I did not turn on the video stream. So, hey, how are you, my friends? Good to see you. Welcome to the session, everybody. August 13, as I was saying. Welcome to the session if you are with us live, as well as if you're watching this recorded. Welcome. Today is a longer term session day, so we're going to be looking at the markets from a little bit of a longer term perspective. It doesn't mean we're going to be looking at super long term moves, but certainly active trading beyond intraday trading, of course. So we're going to be looking at directional trades, non-directional trades. We use options for those purposes, and we'll be looking as well at the trades that we have identified in prior sessions and how they did, so we can learn from those experiences as well as building new trades. Of course, the markets are open if you're watching this live, and therefore ready to execute as well. Okay, Sandeep, good to see you, my friend. Very good. Welcome to the session. So before we start, as always, there is a disclaimer that I need you to read carefully. So please go ahead and read it. Videos are for demonstration and educational and instructional purposes only. So make sure you are clear on that, and that if you execute any of the trades that we plan in the session, is because you are open to do it, and it's your decision. Of course, from my end, I'll be looking at trades that make sense when it comes to meeting the rules of the methodology, etc. But executing this trade with real capital, paper money, larger size, smaller size, or any other combination, of course, that's going to be your decision. Here we go. So the session is officially introduced, and therefore we are ready to begin. And here is TradeStation, okay? And we are ready, again, as I was saying, we are ready to begin our session, okay? So let's begin first with reviewing some of the trades that we have running, okay? CVS, okay? CVS is one of the trades that we have running, such a teaser. So I think, was it this trade? I believe so. I think in the prior session, I classified this trade as the most boring trade of the last month. And I think that's a fair definition, even though it's not a formal or an official way to look at trading. But certainly price going down, price going up, price going down, price going up, and then price going down again. Basically, we are back to where we started, okay, which was on that particular day with a vertical line. We got started at 64.56, and price is currently trading more or less at the same price. So what a waste of time. This trade is not going anywhere. And obviously, if you were to look at the P&L, of course, options decay as time passes. So even though we are basically dealing with a trade that is more or less at the same price where we were, so you can see that out of $152 that this option cost us, the current P&L shows that almost all the premium we paid is lost, 138.5 out of 152. These trades still have 8 days to go. So really, it would be major surprise to end up profiting on this trade. It's going to be tough, isn't it? It's going to be tough. Actually, I remember last week recommending that if at any moment in time this trade was to break even, get out of the trade, because certainly planning on reaching targets now, it's a utopia, isn't it? It's not going to happen. I mean, it could, but it would be very, very unlikely to reach the target we had when we planned this trade all the way in July 2nd. Okay, so today we are starting the session by reviewing a trade that basically didn't do anything for us, produced a loss in the account, but at the same time, it was a good thing to have it, because if the markets had moved intensively to the upside and that particular stock had progressed in that direction, so this trade would have paid, okay, but it's not been the case. And certainly we are dealing here with a pharmaceutical stock. Obviously, the health industry worldwide is in a pretty weird situation, in the sense that nothing is defined at the moment health-wise, and I guess this price action on the stock represents that. Okay, it's just a guess. I don't know for sure why that stock didn't define itself, but the fact is that it didn't. Okay, and therefore this trade didn't do anything for us. Okay, now having said that, not everything is a bad news. So we can look at Philip Morris, which is another trade that we put together. Okay, a trade that we entered on that particular day, that was 7/31st, and this trade hit our target 79.09 just a few days ago. Okay, just a few days ago we hit our target, and this trade did work well. I was looking at the prices of options, okay, and basically this trade produced around a 50% return on investment. So the price of the call we bought was around $2.5 or something like that, and the call could have been sold for around $3.5, something like that. So we made $1 out of $2.5 cost. Actually, it's not 50%; it's maybe 35%, something like that. Okay. So not an impressive trade, but certainly a trade that did work well. Even though I would like to comment on something because it's critical for you to understand, and also because one of you emailed me commenting on a problem that happened in this trade. And this has to do with the fact that reaching the target didn't happen by hitting the line, but reaching the target happened because there was a gap up from the prior day into the next day where price started trading above the purple line right at the open, okay, right at the open. So what happens right at the open? Well, if I was to look at an option chain of Philip Morris right now, okay, I'm going to load Philip Morris. The market opened a little over an hour and a half ago now, isn't it? So when you look at an option chain, you're gonna see a specific level of spread, 0.96 to 104. That's the spread we got, and that would be what you would see, if you were to execute this trade during market hours. Okay, but if what happens is that you have a gap up. Okay, you have a gap up, and the stock reaches the target with a gap up. What's gonna happen is that when it's time to exit the trade, this is when the US market is opening. And right at the open, okay, we had sessions in the past that we conducted around 9 a.m. in New York, so 30 minutes before the market opens. So what happens is that the process of the market opening, depending on which stocks, every stock is a bit different, but for some of the stocks, for sometimes up to 15 to 20 minutes, there is very bad liquidity on the options until the market stabilizes, like it is stabilized now for Philip Morris. Okay, so one of your classmates in the group executed the trade with a market order. Okay, instead of using a limit order to get out, he used a market order and got a major amount of slippage that actually produced a loss, even though the trade worked perfectly well, going from entry to target, but the result of the trade was a loss. Okay, so I want to reemphasize one more time, and this is an important concept when it comes to options trading, that with options trading, you don't want to use market orders. Okay, you don't want to use market orders unless you are trading extremely liquid options, such as options on the SPY or something like that, which are very, 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 very liquid. So then it could be okay to use market orders, but for everything else, instead of market orders, the way to go is to use limit orders, and you can use advanced functionality when it comes to options, such as you can select features such as join the bid or take the ask. So you can use certain functionality where while you're using limit orders, you will not miss the fill, but at the same time, you're not going to get filled at prices that are whatever market makers want, because when they see your market order come in, they basically cancel their orders and they get you a major slippage, like it could happen when you get a trade right at the open because the stock is gapping in your direction, reaching your target with a gap, which should produce a better profit. But next thing you know, you get killed on slippage because this is happening right at the open. Okay, so keep that in mind, guys. Okay, because again, this trade was a very nice trade, but using the wrong order type could have produced, which is the case of one of your classmates, could have produced, and in this case did produce a loss when the stock actually moved in the right direction. Okay, so remember, options trading, guys, we are dealing with derivative contracts, okay, and those contracts got life on their own. So while they derive the price from the underlying, and as long as Philip Morris is moving up, the calls will gain value. Well, there are other moving parts in options trading that you want to make sure you master before you really commit capital and serious capital to the trades. Okay, very well done, by the way, by your classmate in the sense that he was executing those trades with paper money as he's learning. So when it comes to suffering a real loss. That did not happen, but I wanted to take advantage of this real situation for you to understand a bit more and gain a few more insights when it comes to options trading. Okay. What else? Nike. Okay, so Nike is another trade that we have in the account. Okay, and this trade, as you can see, is a trade where we got. This is a trade where we were expecting Nike to fall. Okay, so that was a shorting opportunity. If I look at my managed tab here, and instead of CVS, I look at Nike, you will see that here we are using puts. So we got 64 days to go. We are using puts, and therefore what we're expecting to happen is for Nike to fall. Okay, that's what we're expecting to happen. We're expecting for Nike to fall. But notice what just happened. Nike went to the moon, very, very strong movements, okay? And it's moving in the complete opposite direction, okay? So that will happen from time to time. And again, the way to deal with options and stocks, or stocks with options, or options on stocks, it's to build portfolios where you have multiple trades pointing to the long side with positive gamma, multiple trades pointing to the downside with positive gamma as well. So what's happening, what the positive gamma does, okay? And notice that no matter the direction, I got positive gamma everywhere. Take a look at this. So I'm gonna customize the columns. Let me add gamma so you get to see the gamma. Okay, I'll move the gamma next to the delta. Here we go. Okay, so notice how gamma is positive no matter if it's CVS or it's Nike. Okay, and what the gamma is basically doing is that the gamma is making your trade to profit faster if the stock moves your direction, but the gamma is also making that your trades lose more and more and more slowly. So there is a deceleration of the pain when the stock goes against you. Okay, so notice that the cost of this trade was 385. So the most you can lose is 385. We are currently underwater by 278. Not a surprise because the stock is moving against you majorly, okay, from 97 all the way to 105. If you do the math, okay, this is a pretty intense percent move against us in very few days. Okay, so some investors would be happy if the stock had moved by that amount in 6 months, and this happened in just a few days, isn't it? So it's a very, very intense move. But what's the beauty of gamma? Okay, well, the trade doesn't look pretty because it's negative and red. The beauty of gamma is that we are still far from the maximal pain of the trade, and we still got 64 days to go in this particular example. So it could absolutely be that the S&P has an attempt to make all-time high and needs to have a pretty severe crash before turning back up and continue moving to the upside. And if that's the case, this Nike trade, which is currently underwater, will start profiting for us if this was to happen. Okay? It will not be the first time, isn't it? So now in parallel, the idea is that you have a portfolio, as I was saying. And by the way, in the YouTube channel, in the sharpening playlist, you will be able to watch videos that talk about portfolio management and things like that. So the idea is to build a portfolio where not only you have two positions like I do here, okay, because those are the trades that we do in the session. We meet once a week, 1 hour. So that's as good as it gets. But when you do it for yourself in your account, you want to have multiple positions to point to the upside, multiple positions that point to the downside, all with positive gamma. So when the market moves in one direction, true it is that some positions will lose for you, such as Nike, okay? But other positions will profit. And because of the positive gamma, the ones that profit faster. The ones that lose at a decelerated rate. Now I said it. And basically what happens in the end is that you start producing results as long as the market moves. If the markets become very boring, that's when it's challenging. And then that's why also in the sessions, we look at non-directional trades to make money while the markets remain sideways, if that was to be the case. Because, of course, when the markets remain sideways, you are losing money on time decay, okay, which is your negative theta, okay? But if you have positive theta positions, which are non-directional trades such as iron condors or credit spreads, so those trades will offset the theta while you are exposed to the positive gamma with positive and negative deltas to be diversified, okay? And again, hopefully I didn't confuse you too much with a quick summary of some of the key elements on how to deal with a portfolio with options. But again, if I did confuse you, take a look at the sharpening playlist on our YouTube channel and make sure you watch some of those videos that talk about portfolio management, okay? Good. So anyway, that's it. Okay, so we have it for today: CVS, Nike, and Philip Morris. So time to begin planning for trades, and I'm going to start with non-directional trades since everything we got in the account is directional right now. So let's begin with non-directional. I'm going to start with Alibaba, and as I load Alibaba, I will also bring a trading view so I can go ahead and input the stock symbol so I can evaluate when is the next earning day is going to happen, which is August 20. And I'm pretty sure you are guessing it. That's not a good news because the next expiration date is August 14, which is tomorrow. That's difficult to get good premium if you only use one day to expiration. So the next expiration date, which will be the typical one to use, will be the next Friday, which is on the 21st. But having earnings happen on the 20, then of course that's going to be a no-go, isn't it? So we are not going to be able to do a trade on Alibaba unless we find a way to make it work using tomorrow expiration date, which is August 14. So let's take a look at Alibaba. Well, first of all, bad news here, 44%. That's not acceptable. So what if I look at pre and post market session? Well, if I look at pre and post market session, almost we need 48%. We get 47.9. It is below 48%. And you may say, wait a minute, it is only 0.1%. Yeah, but if we're going to do exceptions, then we'll find excuses to do exceptions for everything. So it's going to be a no-go, even though it's pretty close. We're going to move to the next one, which is VMware. So let's take a look at VMware. 39% here with a pre and post market data. So for sure that is not acceptable. Regular session is providing us with 44%. That is also not acceptable. So we'll move. I would move to Tiffany's. Okay, but I'm not gonna do anything with Tiffany's. Let me show you why. Again, I cannot comprehend what's happening to Tiffany's for a long time now. I have no idea what it is. I've been researching and I don't find any reason for that. But when you look at the option chain on Tiffany's, look at that. Okay, like 001, 4.90. So there is zero liquidity there. Okay, and the funny thing is that there are thousands of contracts, even though in recent times there is no volume. Okay, so something's going on with this company. I don't really find what's going on. Funnily enough, the stock is traded heavily, lots of institutional interest, but in the options markets there is no liquidity. So someone knows something I don't know, and when that's the case, I have to be humble and pass on the trade, because if not, that will be a gamble, isn't it? So that's what it is. Okay, and maybe you guys know what's happening, but I don't. Paul, how are you? Thank you for joining us. Thanks for that message. No worries at all. So FISV. Okay, so this is the next one that we have on the list. So let's take a look at FISV. Okay. FISV. Oh, okay. I am in the Forex tab. Okay, that's why. Stock. FISV, NASDAQ exchange. Here we go. So earning date, it's happening all the way in November. Okay, so that's great. Okay, that's great because we can use next Friday, the Friday after, the Friday after. We have no restrictions there in the sense that earnings are happening much further in time, while we have 54%. That's beautiful. Okay, now, of course, my concern here is that the UFO is so far away. We won't be able to do a trade unless we have closer UFOs. So let's take a look at pre and post market, and hopefully we'll have more UFOs. We do, but they are 45%, and 45% is not acceptable. Okay, so yeah, it's looking powerful for that stock, but with those UFOs so far away, we will need to sell the 100 plus options, and given the distance, we are likely going to waste our time if I was to plan this trade. Okay, so I'm gonna move into the next trade. Okay, PDD. Okay, which we see 45% here. We need to wait for the pending data to be gone to really evaluate if this trade is executable or not. 45% not acceptable. We need minimum 48% for non-directional. What about pre and post market? So pre and post market, it's 45% too. So we're gonna pass. So we go for the next one, ATVI. Okay, by the way, you may have noticed as well that the size of my list today, it's shorter than normal, okay? And this has a lot to do with the fact that the market is behaving very nicely in recent times, and everybody's getting calm, and the VIX, the prices of options are going down, so the scanner is picking up less opportunities, okay? That's gonna make it more difficult for the non-directional trades, okay? And after a while, it will make it easier for the directional trades. But there will be a moment in time where the options go from expensive to cheap or from cheap to expensive, where most of the options will be somewhere in between. And somewhere in between, you don't really have an advantage. And then there's going to be a time where we will see both our directional and non directional size of the list to shrink. And it becomes a bit more difficult to trade. Okay. We need to be a bit more patient. Okay. So we may see that happening soon, or maybe actually right now. Right? Okay, so we'll see that. So 45% is not acceptable on ATVI using pre and post market, but if I was to look at regular session, that becomes 56%, and this not only is acceptable, this is beautiful. Okay, this is beautiful. Now, of course, if you look at the UFOs below, the UFOs are so far away that again, I'm probably going to have problems when it comes to finding premium. So I'm just going to move to the next one, GDS. And see if that's going to work better. Okay, so pending data for GDS. Okay, so we got 46%. That is not acceptable. What about pre and post market? 34%, absolutely not. So we're going to move to JD. Okay, we got two more on the list. So 46% with pre and post market. If we look at regular session, that becomes 46, no good. So last one, eBay. Let's see if eBay gives us a go. So pending data. Okay, pending data. Let's see. Here we go. That's 53%. That's good. And if we look at pre-post market, we get, what do we get? Okay, we got 43%. So 43% is not acceptable. So we're going to stick with regular session data. That's relevant information. Now, what's happening with eBay? So if I look at the monthly time frame, notice how eBay is basically making all times high, right? So the highest price was traded right there. That was July 13. Okay, July 13. So when I look at the intraday time frame, so July 13 happens to be that peak. Okay, and what's the problem? Well, the problem is that we have one UFO, and what I mean by one UFO is one UFO only. For non-directional trades, we need at least two UFOs, and in this case, we only have one. So what's the consequence of this? Well, the consequence of this is that we cannot plan on a trade where one of the rules is not met. We need two red UFOs and two green UFOs, but we only have one red UFO on the screen. Sure, it is 53%, which is acceptable, but we need two and we only have one. So we are not going to take the trade. So today, when it comes to non-directional trades, we went through the list. The list is a bit shorter. Okay, we got a collection of new symbols, okay, compared to the last time. The new symbols are the ones with the blue color, like, for example, Alibaba, ATVI. So all of those are new symbols that were not in the list before, but the list is shorter than before. The other time it was like maybe 20 symbols. So again, why is that happening? So let's take a look at the VIX. Okay, so the VIX going down 2% today. So, you know, if we look at the daily time frame of the VIX, so going down, going down, going down, going down, people getting calmer, getting calmer, getting calmer. No one is scared anymore. Why is that? Well, because if we look at the S&P, okay, the S&P is going up, is going up, is going up, and it seems that it's going to be making all-time high, or almost right there, right? And most people will look at this like now it's going to the moon, and then no one is concerned. No one is concerned. People don't buy protection. People don't buy options, and then the prices of options become cheaper, and then the VIX goes down. Okay, so again, that's the consequence, and that's why we see our list to be shorter. Okay, but again, let's be patient, because if we catch some directional trade and the market starts making all times high, we're gonna profit from it. If the market is gonna tease us, okay, peak and then crash, okay, so what's gonna happen? Well, we'll catch moves to the downside too, and in the meantime, the prices of options will inflate one more time, and then we'll be able to add more non-directional trades because the prices of options will be now overpriced. Okay, so again, we just adapt to what the market gives us, which implies we need to be patient, waiting for the right setups, and being ready to discard trades more often than accepting trades. Okay, which is tough. Okay, it's tough, especially when you know, we sit in front of the computer and we are ready to trade, and now, you know, our job is to not to trade at times. So certainly it's a bit frustrating, but this is how we add quality to our trading, which is to be selective. Okay. So anyway, what else do we have? Well, notice how I clicked on the credit, okay, on the credit filter, on the credit scanner. So I'm looking for opportunities to build credit trades. Okay, I started with Baidu. Notice that Baidu is giving me 43%. So this is credit trades or neutral trades, are also trades for a credit, such as non-directional, such as iron condors. And in that sense, we have the same rule. We need at least 48%. This is 43.75%. That is not good enough. So we're going to move to pre and post market to see if it's better. And it's not. So then we'll pass on Baidu. Okay. GDS, I believe we saw that earlier, isn't it? And it was not acceptable, 34%, or regular session is 46%, so no good. COF, okay, Capital One, that one has 38%. And if I look at pre and post market, it becomes 35%, so certainly not. SPG, okay, Simon Property Group. So let's see what's going to happen. 52%. Okay, that's acceptable, even though there is no green UFO close by, only one. So let's move to regular session. Okay, that's 48 point something percent. So that's good. And we have multiple UFOs below price. Okay, so now we are talking, we may have an opportunity here. Before I get too excited, let's check earning dates for SPG. And we are indeed talking. There may be an opportunity here for us to do a trade because earnings are all the way in October. The prior earnings took place in the 10th of August, okay, 10th of August, which is 3 days ago. And therefore, it's certainly a valid time to plan on a credit trade, for SPG. Okay, so loading SPG. Okay, and let's see if the whole set of rules that we follow will allow us to take the trade or not. Again, looking for quality in this case. Now, notice something here when it comes to SPG. First thing that you notice is that we don't have weekly expiration options. It's all monthly expiration options. Okay, so this is telling you that this is not the most liquid stock in the world. But at the same time, because it's monthly, okay, all the liquidity should be concentrated in them. And I would say it should be okay. And it is indeed okay. 37, 38, 17, 18, 105, 130. That's a bit more painful, but it's okay. And again, it's not amazing, but it's doable. It's okay for us to trade such options, assuming we're gonna get enough credit. And we may or we may not, depending on the strike selected. The challenge here, let me tell you, is gonna be the fact that the strike price increments are $5 at a time. Okay, being $5 at a time, we don't have much options to adjust the trade to some risk level that makes us happy. So it's either it works or it doesn't, because already by default this trade would have $500 of risk minimum. Why? Because the difference between strikes is $5 times 100 is $500. That's the minimum risk we're going to be able to have. So it's not like we're going to be able to build a credit spread with $100 of risk or $50 of risk. In this case, it's going to be all the way 500 no matter what. Okay, so that's certainly, it's a disadvantage, but it's what we have. So let's go ahead and take a look and see if it's something that makes sense doing or it doesn't. Okay, so I'm just going to add, as you can see, I just did a credit spread. I am now changing the settings for the price slices to be one standard deviation above minus one standard deviation below. And what this is telling us is that using August 31st expiration date from the current price, which is 66.22, that stock could move easy all the way to 60.22. That's a one standard deviation, and that's why I said easy. One standard deviation is something that if it was to happen, it's not something weird. It's something that is actually likely to happen. All right. Again, I'm oversimplifying the how to read or interpret statistics, but it's an easy way to think about it. If you wish, one standard deviation is where price may go. Okay. Now beyond that is where we are entering now the territory of less likely to happen. Okay. So below 60.22 is less likely to happen. Okay. So I would like to be able to sell options below 60. And if I look at my option chain, let me rephrase that. If I look at my chart, the UFO that is below 60 is going to be that UFO right there. So I could be selling options below 57, okay? And if I was to do that, that would be, from a probability standpoint, a trade that makes a lot of sense, okay? Now, going back to my concern, there is no 57, okay? There is no 57. The next one is 55, okay? And if I sell the 55, I'm only going to get paid 15 cents, which invalidates the rules, because we have one rule, which I will rephrase just in case you don't know it, which is every time we sell options, the one we sell, we want to make sure that at least we're going to collect at least 35 cents for it, okay? And in this case, it's 15, which is far from 35 cents. And the problem is because that 57 is far. So the 55 option pays very little, okay? So an option is to move to the next expiration date, okay? And then if we were to sell the 55, now you get paid 121, so that's a totally different story. But again, of course, why do you get paid more? Because now price is more likely going to get there. So how likely is that? The way to know that is to come back to your analysis tab and change 21st of August to be 18 of September, right? And when we do that, now probability suggests that reaching 54.32, it's doable. Below 54, it's not, but reaching 54, it's not a strange thing, okay? So in other words, you would want, okay, going back to the chart, you will want to use UFOs that are below 54, and in this case, we have UFOs at 54, so that would be the UFO to be used, and sell those options below 54, okay? Now, we don't have the 54 strike, okay? The nearest it gets is 55. So if we were to do this trade, we will need to do 55 and 50. Again, good news, the 55 does pay 119. So let's go ahead and take a look and see what happens if we were to sell the 55 and then buy the 50, okay? Notice here I got -1, red color, +1, blue color. So sell the 55, buy the 50, put using September 18. And that is telling us that if we were to do this and we were to collect the midpoint, so you would get paid 66 cents for the spread. Okay, so the rules we have are, number one, we need to collect at least 35 cents for the option we sell. And we already said that's good, not a problem there. Okay, we got that. The second rule we have is we need to look at the roll risk. The roll risk is $5, is the difference between strikes, correct? And the second rule we have is that out of this difference between strikes, we want to collect at least 15% of that. Okay, in premium. So how much is 15%, okay, of 5? Well, 15% of 5 is 75 cents. And how much we get paid? We get paid 64. So in other words, it doesn't work, okay? It doesn't work. It's not too far. If the market was to fall hard, okay, so maybe you watch this trade and let's say it's actually falling quite nice, actually 2%. But let's say tomorrow the market gap down and opens, somewhere here. So now, you may get another 1%, 2% drop, and now people may get very scared. Those options are trading at a higher value, and now you get your 75 cents, and now it would be okay for you to take this trade. As of now, we are close, but we are not meeting the rule, and therefore this trade is not to be accepted. This trade with SPG is to be discarded. So moving to the next one, RTX, okay, and before I go, you guys have been very quiet, and there's probably a reason for that. I've been nonstop. So go ahead, please, and type on the chat box and let me know how things are going. Maybe you are busy replicating those trades on your computer screen, and that's why you are very quiet. But even if you have nothing to say, just go ahead and type all good. That would be important for me to get a bit of feedback from you guys. That's always very, very, very useful. Okay, guys, so please go ahead and let me know a bit better. How are you on your end? Are you following? Am I going too fast? Is it all good? Just share with me, guys. Thank you. So anyway, Raytheon Technologies, we can see here that 44% is not acceptable. So moving to pre-post market, which provides 45, a bit better, but not enough. Okay, Sandeep, we are here. Very good. I hear you, my friend. TJX, let's take a look. Okay, and FL and WFC, I'm going to skip it because it's only $29 per share, so it's very low. So 39%, that's not good enough. What if I move to regular session? So now we got 50%. Okay, so 50% is good. So the next question is TJX, when are the earnings? And the earnings for TJX will take place on the 19th of August. Okay, 19th of August. So we cannot do this trade. Okay, we cannot do this trade unless we do tomorrow expiration. And with a $57 stock, I'm not gonna waste the time looking into it because it's basically a sure thing that there will not be enough premium if we use tomorrow expiration, and we cannot use next week expiration because next week expiration is on the 21st, where earnings are on the 19th. Okay, so it's not gonna work. Okay. Good, Furman. Good, Jose. Just following you. Well, love it. Perfect. Paul, taking it all in, Jose. I don't trade options at the moment, but interested for the future. Got it. Totally get you, Paul. It's absolutely fine, guys. If you guys are quiet and just listening or making notes or both, it's absolutely fine. But again, it's always good to get your feedback. And certainly, if you have any question, guys, even if you are new to options or you don't trade options, but you have a question, don't be shy, guys. This is an opportunity to learn, and I'm here for that. I'm more than happy to pause and go ahead and talk about it. Okay. Good. So any opportunity here for the credit spreads to the downside. So let's take a look. TAL 46% and 38%. So it's not going to be good. Newmont Mining, that one should be okay from a probability point of view, I believe. So we got 45. We're actually pending data still, so we need to wait. Okay, 1, 2, 3. Here we go. 45% with pre-post market, and regular session is 51%. So yes, from a probability point of view, is good. What about earnings? NEM earnings are happening all the way in October. So certainly we have an opportunity here, at least to plan a trade. We have multiple UFOs on top of price, at least two. So everything is good to take a look at the option chain of Newmont Mining and look deeper into if this opportunity will be valid or not in the end. Okay. So Paul, do you only trade options on stocks for your longer term, or do you look at other markets as well? Yeah, options on stocks, options on ETFs, that would be my bread and butter. Certainly options on futures is a beautiful thing to be done because of the premium built in on those options. The contracts are larger, so premium is pretty impressive at times. But obviously now you are dealing with a derivative of a derivative, so it's just a bit more complex. And I would say if you're in learning stages, specifically in your case, Paul, as you suggested, as you stated, probably the best approach for you is to do some practice, even if it's a paper money account, but do some practice with options on equities or options on ETFs. And then certainly, why not open the door to options on futures, which are beautiful as well. Okay. Cool. So Newmont Mining. Okay. So I'm going to look at August 21st first. I'm going to right click to analyze and sell vertical. Okay. Just so we get the stats. And here, using August 21st, it says the highest it should go based on stats, it's 68.67. So looking at the chart at 68.67, which is more or less here. Okay, more or less here. So in other words, using that UFO that ends at 70.5, that would be the way to do it. Okay, that would be the way to do it. So let's take a look. Okay, at 70.5, and there is no 70.5, there is 70. That's good enough, and it's 21 cents. Okay, which does not meet the rule of our $35. Okay, so what do we do in such case? No problem. We look at the next expiration date, which in this case is August 28. Okay, August 28, 70 option is paying us 60 cents. Okay, 60 cents. That is valid. Now the question is, what about probabilities? Would probabilities suggest this is a smart trade, or probability would suggest it's too close, right? So August 28, it's moving our probabilities to be 70.39. Okay, and if we were to look at the chart, 70.39 is actually below 70.42. So actually, it seems that we found a possible setup which is going to be valid. Okay, so let's see if that's going to be the case. This may be the trade of the day. So let's continue planning the trade. I'm just going to add a bit of documentation on the screen. So first, we are dealing with this trade as of now. Okay, we are planning on a credit spread. To be more technical, it's called the bear call spread. So bear call spread, and a bear call spread is made of buying a call. Okay, and sell a call. Okay, now which call are we going to use? Well, we saw that the 70 is available. So my initial plan would be to sell the 70, buy the 71, and the expiration date to be used, as you saw, in this case would be August 28, 2020. That would be the expiration date to be used in this case, knowing that earnings are happening way later, which is, I believe, is October 2020. If I'm not mistaken, let me see. October 27, 2020. Okay, so it's there is a while, okay, before that happens. So we're gonna be out of the trade way prior to earnings, which is the way to do it, really. Okay, so you avoid any sort of gap risk, a gap against you or something like that. Okay, so let's do it. Let's add this in our simulation tool to see what happens if I sell the 70 call. Okay, and I buy on top of it, okay, the next strike, which we don't have 70.5, but we have 71. Okay, so if I sell 70 by 71, so let's see what's going to happen. Okay, let's see what's going to happen. And it's a bit sad here, guys. It's just a bit sad because we're going to get 12 cents. Okay, so again, from re-describing the rules we have, okay, we first need to make sure we get at least 35. Okay, and we get 59, so that's good. But then when I get paid 59, but I pay 46 for the 71. Okay, so the difference between those two, okay, basically suggests that the midpoint of this particular trade is going to be 12 cents. Okay, 12 cents. And what does that mean? Well, that means that we are not meeting the second rule, which the second rule, as you saw earlier, is to look at the roll risk, which is the difference between 71 and 70. That's one. And we want to collect at least 15% premium, which is obviously 15 cents. Now, what happens? We only get 12. Okay, we only get 12. We need 15. We only get 12. Okay, so now the bid is 18. The ask is 6. So again, could that get better during the day and you may get 15? Yes. Right now we just dropped to 11, now 13. So, it could. Okay, if you're patient, you place an order for the day and you may get filled. Okay, but I'm not fully sure that's going to happen. So in this sense, I would like to explore. We still have a little bit of time left, isn't it? So suppose 3 minutes. Okay, let's see if I can do it quick. So I would like to look at the next expiration date and see what's going to happen. So if I do 70 and 71, for example, so yeah, that looks like it could be okay. But of course, if I use the next expiration, which is the 4th of September, so now 71.67 is not going to be enough because 71.67 is going to be there, which means I need to be pointing at the next UFO, which is 72. Okay, so the trade changes. Instead of selling the 71 call, selling the 70 call and buying the 71, now I'm going to have to be selling the 72 or the 72 and a half, something like that, and buy one above, maybe the 73 if it's available. So again, let's take a look at the option chain and see what's available using September 4. So using September 4, we got 72. Let me add more strikes. So do this. Yeah, so we got 72 and 73. Okay, so we could do that and notice how it's not gonna work. It's not gonna work because this one would pay us 63, that one would have us pay 52. Okay, so we are a bit stuck. We are a bit stuck there. If I do 72, 73, as you will see, it will not work. Okay, it will not work. It will produce 12 cents. Okay, now I'm not gonna give up yet. It's not looking good, to be honest. Probably it's gonna be a no-go, but I'm not gonna give up yet. I just want to try another possibility. Just looking. So guys, we also have 73 and a half and 74. So one thing I could do is try the 73 and a half, okay, and see what happens. So if I try the 73 and a half, notice we had some improvement, even though it's not enough, unfortunately. As I said, it was not looking good. So the raw risk is 1.5, which is the difference between 72 and 73 and a half is 1.5. We want at least 15% in premium. That's 22 cents. Okay, and what do we get? We get 16. Okay, so that's not good. So what if I do 73 and 74? 74 gave me the impression of lack of liquidity, so I don't think we're going to improve much. It's 19. Okay, it's 19, but it's not good because now we have a risk of 2. 15% of 2 is 30, so now we only get 19. So yeah, so it's a matter of patience. Okay, you can try. I think the other setup that we had with August 28 using 70 and 71, right? 70 and 71. Here we go. Yeah. Which is now paying 10 cents. Earlier we saw it go up all the way to 13. So with a little bit of patience, maybe during the day you see that value to hit 15, and then you have a trade. But yeah, it's not looking like it's going to be an easy one. So I'm just going to delete the lines because I don't think this is a trade that we're going to get filled during the day. But you can certainly give it a try throughout the day since options prices change. Especially the good news here, though, is that there is an open gap above. This market just keeps testing the highs of today and the high of yesterday, right? So if there is a breakout, okay, if there is a breakup, maybe quite intense. If it's a bit intense, options prices will increase because of two reasons: because price is going up and because there is more volatility. And then I believe you would get your premium. Okay, but again, this is something for you to watch since the session is now over. And it may or it may not happen during the day, but just watch it, because if it happens, you will get your 15 cents in this one. I would say that's possible. Okay. Also, a little tip there: Newmont is a mining company, obviously, right? And what happens, is that just like the stock market crashes down, okay, equities go up and then they crash down. Commodity markets normally is the opposite. Okay, commodities, the old school saying, if you wish, which is not always the case, but just like sometimes the markets go up at a very fast speed, right? I'm talking about equities that will go up very, very fast, and it's very surprising because we all expect a lot of speed only when the markets fall, and sometimes they go up really, really fast. So commodities is the same. Normally, when they go up, that's when we say they crash. Actually, we say commodities crash up. That's how it's said. Sometimes they crash very aggressively, like for example today or a few days ago. What a huge gap down, which by the way, that I believe was because of earnings. But anyway, so good news. Coming back to my comment before, commodities tend to crash up. So if that market, that stock, which is related to commodities, was to start making highs above those highs and starts filling in this gap, we may get to see huge speed to the upside in order to reach those higher UFOs, and that may give us the premium we need to do this bull call spread. Okay, and before we conclude, I'll add one more tip for you to know, which by the way is the reason why my sequence when looking for trades is always non-directional first, and then I look for credit trades to the upside, and then the last one is to look for credit trades to the downside, because credit trades to the downside is bull calls. Let me rephrase that: is bear call spreads. They are made of calls, where credit trades to the upside is bull put spreads. They are made with puts, and the puts normally have more premium than the calls, so it's normally easier to get the premium you need with the puts than getting the premium you need with the calls. In other words, it's more difficult to get yeses when you do bear call spreads than getting yeses when you do bull put spreads. Okay, and certainly iron condors normally is the one that pays you the most, so it's the easiest to get a yes. Okay, even though today, as you can see, everything is very calm. The S&P is going up 0.07%. It's kind of flat. The VIX was going down 2%. So the scanner kind of told us with few opportunities that premiums in options were not that high. Okay. So anyway, my friends, no trade today. Okay, no trade today. For now, I mean, if you keep looking for opportunities later in the day, I'm sure you'll find we find trades every day, really. But during these 45 minutes that we spent together, we didn't get any trade meeting our rules, and therefore, while it's not ideal, we are very very happy. And if you're not, you should be. You should develop a mindset which is totally carefree state of mind. So if we didn't find a trade, you should be okay with it. You should be happy with it because it's part of trading. Just like taking a profit is part of trading, taking a loss is part of trading, missing on a trade is part of trading, not finding a trade is part of trading. Even having computer problems and sometimes your trading station logs and you cannot trade that day, that's part of trading too. So just keep it cool, keep up a good positive energy in your trading. Maybe you go for a walk, you go for a run, you come back, take a shower, look at the markets, and then you find your trade. Okay, so that should be the mindset for you to keep when we have a situation where we're looking for a trade and we don't find anything tradable at the moment. Okay, so we need to use a bit of patience. Okay, instead of trying to force a trade that is going to be less quality if the rules are not met. Okay. Very good, everybody. A pleasure. Thank you for seeing us, for joining me here, guys. It's great to see you. Thank you for that, Paul. Thank you for that, Fermon. Thank you, everybody. If you're watching this recorded as well, a pleasure to have you watching us, guys. You guys take care. And if you have any question, contact us. Support@tradictive.com, and we'll be delighted to work with you guys. Take care. Bye bye. See you soon. See you in the next one. Bye bye.